Be ready, this is a warning. The biggest market crash of our generation is here. The Dow and S&P 500 posted their worst 3-month period since the first quarter of 2020 when COVID lockdown sent stocks crashing. Over the past 3 months, the tech-savvy Nasdaq is down more than 20%, its worst get since 2008. The 20% fall of the S&P 500 in the first 6 months of 2022 is the poorest half since 1970. It's led by worries about the Fed's interest rate hikes, unprecedented surging inflation, China's COVID lockdown, and Russia's invasion of Ukraine. And that isn't a joke. The worst year in half a century tells us a lot about the dire situation. Even getting rid of the gold standard in 1971 by Nixon didn't provoke such a crisis. It isn't just about the S&P 500. Look at Nasdaq. It's having some of its worst times in decades. We've already had a wave of bankruptcies, particularly in the crypto world. If this was the end, we could have said, all right, we had a bear market and things will get better soon. But the problem is that this is just the beginning. We discussed in previous videos what has generated such a bubble in the last 2 years, but what's happening now is about more than just the previous 2 years. The crisis is much more severe than that. The bubble now unfolding is the result of the Fed's action for the past decade, if not more. So it's going to be around for just 6 months. What we've witnessed in the first half of 2022 is a taste of what's coming. The Fed perfectly knows that, and there isn't much it can do, so it's trying to ease the pain. It's not going to be as safe as we like, but we should get used to it because the everything bubble is about to burst. But the real question is, what is the everything bubble? How did we end up forming such a massive bubble, and how bad the future recession will be? We have all the answers to these questions and many more, but before that, do give this video a big thumbs up and let's dive in. In 2022, as calculated by the CPI-U, inflation posted its most considerable 12-month increase since February 1982. The 12-month gain was 7.5%, up from 7% through December 2021. Price hikes for food, electricity, and shelter majorly contributed to inflation. That's when the Fed could no longer hide that it was worried about inflation. No matter how many times it hiked the rates after that, it didn't help since. In February, the rate was 7.9%, and in March, it got worse and grew to 8.5%. In April, 9.6%, and finally in June, 8.6%. If we compare that to June 2021, that's multiple times higher since inflation was just 2.1%. So, what exactly happened so unexpectedly that things got out of control in the glimpse of an eye? Well, nothing. Inflation has been around since the Fed used quantitative easing to save the economy in 2008. Wait for a second. If you examine the data, inflation has averaged about 2% for the last 15 years. If we're talking about consumer prices, then yes. But if we're talking about asset prices, the answer could be problematic. Since the world got attached to easy monetary policy and quantitative easing, it did everything possible to keep asset prices growing. From January 2010 to January 2022, the S&P 500 grew by around 3% if we take the exact period before that. From 1998 to 2010, it grew by just 4%, and that's different from the economy growing much faster during that period. It grew by around 2% yearly as it did before, but what exactly was different this time? With the Fed at their head, the central banks across the globe loosed financial policy so much that they gave us the misconception of growth. Yes, look at the numbers. Everything was growing fast, but did our efficiency grow at that rate also? No. Did we build much more factories? No. Did we hire more people? No. This is the number of dollars in circulation. Until the 1970s, the amount of currency in the economy was steady. It grew insignificantly after 1971 when the US dismantled the gold standard. It waited to print enormous cash and threw it into the economy. However, it gradually began rising. However, in the summer of 2008, there was a spike. The Fed threw trillions into the economy to protect it. Since then, the amount of cash in the economy has skyrocketed, surpassing its peak in 2020 when a global pandemic hit the world. All that cash should have created inflation, but as we've looked at the Consumer Price Index, inflation was relatively stable at 2%, but asset prices have skyrocketed. Since the top 12% of the population possess 80% of the stocks, only the super rich have benefited from the Fed's easy monetary policy. Just take a look at interest rates. From 2009 to 2015, rates were almost 0%, and the Fed began slowly raising them just in 2016. When you get free money, it's easy to grow because you can always borrow money for free to show that you're doing excellent. The challenge is to create cash without borrowing free money. With low interest rates, companies borrowed and invested wherever they could, even if these projects were unprofitable. Still, it was a major deal since even if you don't have money, you can compensate for that by borrowing more. The situation got so ridiculous that the European Central Bank had a negative interest rate for over 8 years. It's the other way around. You work and create something valuable. In return for delivering that value, you get financially rewarded, but with negative rates. You're rewarded financially just for borrowing money. So if you're not going to use that money wisely, you're not losing anything since rates are negative. Of course, that's an oversimplification because things are a bit more complicated. Negative rates at central banks don't necessarily mean negative rates by the time it reaches the consumers, but you get the point. So the growth we had since the 2008 financial crisis was fueled by cheap money and multiple bubbles, such as the Bitcoin bubble in 2017 or 2020. Low interest rates also led to stock buyouts. When a stock price boosts, we assume that it's because the company performs better. It might have built more factories, hired more people, innovated new products, but usually that's different. Companies use cheap money to buy back their stocks, which decrease their number of shares in the market and hike the price. In 2020, low rates led prices to rise by 25%. Did houses instantly become more prominent, better, or more convenient? Not at all. Everything drove by easing monetary policy. We got so comfortable that we assumed investments would go up no matter what. But how can something rise when there's been no additional value? So imagine for a moment just how big the bubble we've created is. Bubbles are expected since the economy cycles from an expansion to contraction once it reaches peak. The problem is that economic cycles happen every 3 to 5 years, but our last expansion started around 2009 and continued until the end of 2021. Over a decade of economic expansion was driven by cheap money, creating such a vast bubble that we still have no clue how big it is. And now it came to hunt us down by stock market collapse and high inflation. On top of that, the crisis we're facing now has exacerbated everything. All that the Fed can do is soften the situation. It's difficult to say how long it will last, but what's certain is that the worst is yet to come. Thanks a lot for watching. Remember to subscribe, like, and share with your friends and family, and we'll see you in the next one.